What's going on, guys? Hey, my name is Logan Manzanares. In this video, I'm going to share with you exactly how you can get approved for a home loan. Because I'm telling you what, the best partner you can ever have when it comes to buying homes is an awesome lender and someone who knows exactly what you need in order for you to sign that dotted line to get that loan approved. So without further ado, let's go. Hey guys, if you're new here, my name is Logan Manzanares. I'm a business owner, I'm a fitness professional, real estate investor. Me and my wife currently own $4.5 million worth of real estate. We currently have cash flow over 6 figures every single year. And I'm making this channel so you can do and learn exactly what I'm doing, so you can do it as well, to have the financial freedom in your life to do whatever you want with whoever you want, as much as you want to do it. So if you like what you're hearing so far, please like this video, subscribe. Here we go. All right, guys, so one of the most important things you can do when it comes to buying real estate is actually getting pre-approved for a loan. In order to buy real estate, you actually need some help, right? And it's not just about having your own money, but it's also having money from a bank as well. And so I'm gonna walk you through exactly the 4 things that you need to know of so you make sure that you can actually get approved for your first home loan. All right, guys, so one of the biggest reasons that people don't go buy real estate is because they think that they just can get qualified for a loan. They don't know exactly what to do. They don't know the process. They're afraid of getting rejected. They think their credit score is too low. There's so many different things. And so I'm going to share with exactly what you need to do so you actually get prepared. You can get a plan so you actually can go buy your first piece of real estate or maybe your second, third, or fourth. All right, here we go. All right, so there's 4 things that the banks are looking for when it comes for you to get a pre-approval letter and for them to qualify you for a loan. The very first thing is your credit score. The second thing is your debt to income ratio. Your third thing is going to be how long you've been at your job for, so job employment. And your fourth thing is actually how much cash you have on hand. And so in this video, I'm going to walk you through exactly all those 4 things so you know exactly what you need to do in order to qualify for a loan. All right, guys, let's talk about credit score. So credit score is one of the most misunderstood things out there. There's so many different things out there, but I'm actually going to break down the 5 things that banks actually use in order to come up with this thing we call a credit score, okay? And so first thing you got to know is that the minimums in order for you to qualify for any sort of loan is going to be $500 with an FHA loan. But that also is going to require you to put a bigger down payment down at 10%. Now, if you want to do an FHA loan for just 3.5%, you're going to need at least a 580 credit score. And if you want to qualify for just a conventional loan, you're going to need at least a 620 credit score. So those are kind of some of the benchmarks, the lower end that you need to know. And if you get above 700 to 720 to 750, that's where you're getting into like the best interest rates. You're going to get the best terms for your loan. Okay. And so I actually posted a little screenshot right here that you can look at that shows you exactly what the minimums you need in order to qualify for certain loans. Now, let's actually break down what actually makes up your credit score. Okay, so there's actually 5 factors that actually make up your credit score that you see with that number on top. Okay, so the first thing that's going to be on there is your actual payment history, right? So your payment history shows that you actually have things that are reported to the credit bureaus. So these are things like credit cards, these are things like home loans, these are things like auto loans, these are things that are reported and that you actually pay them on time, right? So if you actually look through your credit score, you actually can see if you ever missed payments before or if you're currently delinquent on payments before, and these actually show up as part of your credit score. Now, if you actually don't have any sort of credit, well, that's not good either, right? So because 35% of your entire score makes up your actual repayment history. So if you're somebody out there who's like never had a credit card before, or is afraid of getting credit, like you actually need to go get yourself some credit. That way you have some credit history. So because one of the biggest pieces of your entire credit score is just that. You got to have repayment history showing that you're actually capable, that you actually are someone who's responsible with credit. So I recommend having at least 3 credit cards. And then if you don't have an auto loan, that would be a great place to start with. Okay. So go get those 3 things. All right, so the next factor that I look at when it comes to your credit score is actually how much money you owe, right? And this is actually based on what your total credit is. So let's say that you have $10,000 in credit card lines, right? So it means you have a credit card that's has a $5,000 credit, you have one that has a $3,000 credit, and you have one that has a $2,000 credit limit. So you have $10,000 of total credit. Now, ideally, you want to use under 30% of all those credit lines all combined. So it doesn't matter if you use $2,000 of all of one and then you don't use the other ones. It's all about the total amount of credit that you have and how much you use. And so credit card companies basically give you a better score when you use under 30% of your total amount of credit. Now, if you want to go even to the most extreme end, if you can get 10%, your actual credit score will go up even faster. But that's a general rule of thumb, is that if you're trying to improve your credit, is you want to use under 30% of your total credit amount, which means that if you have old credit cards and you're not using them, great. Don't cancel them, just keep them on there. Try to increase your credit lines. Those are simple things you can do to increase the amount of credit you have without using the actual amount of credit utilization. Another thing you can do to actually fast track this process is actually you can become an authorized user on somebody like a friend, a family member, a spouse who's had a credit card for a long time. You can become an authorized user and all of a sudden you get all that history. So let's say that you have a spouse or you have a friend who's had a credit card for 5 years. They put you an authorized user on there. All of a sudden you can have 5 years of credit history really, really fast. So these are some of the tactics that people use to increase their credit scores really, really fast is by number one, becoming an authorized user. Number one, and the second thing is just making sure that you're utilizing your credit at under that 30% utilization rate. All right, now the next factor that your credit score is made up of is actually your new credit inquiries. So that means if you're going out and you're getting all these credit cards all at one time, you're getting an auto loan, and you're trying to apply for a home mortgage, man, you're gonna look really, really bad on paper. Trust me, I've been there before. And so what you're gonna wanna do is you need to be able to have a plan and strategize when you need to increase your credit. And the best time to increase your credit is not when you're actually trying to actually purchase a home and try to get a home mortgage, right? So if you do need to increase your credit, do it before you're basically looking at actually getting a mortgage. So that means going out and getting credit cards, going and getting auto loans, doing that well before you're actually going to go out and actually purchase a home. Because if you try to do it right around the same time, you're going to get dinged for that and your credit score is going to go down. And the lending institution that you're using, the banker, the lender is going to be like, man, this person's actually looking at getting a lot of lines of credit or getting lots of credit. And then all of a sudden that could drop your score and your potential to actually get that home mortgage. All right, and the last factor that makes up your credit score is actually types of credit. So different types of credit. So the more of these things you have, if you have like a home mortgage, if you do already have a auto loan, if you already have different types of credit cards, these are things that make up that last 10% what your credit score is. So if you can have different and you have some variation on that, that's great. Now again, if you're coming into a time and a place where you're actually getting ready to actually do a mortgage, like don't worry about opening a new line of credit just so you have more variation. Again, that's something that's done way ahead of time strategically, but it's not going to be a big enough factor that you need to open another credit line before you do a home mortgage because that will actually ding you instead of help you. All right, guys, so the next factor we're going to talk about is actually your job history, your employment history. So if you're a W-2 employee, that's actually really great because most of the lenders actually look at W-2 wages as the most consistent and predictable when it comes to repayment of the loan. So W-2 wages are great. Now, let's say that you're self-employed, right? So now when it comes to self-employed, which is someone who I am, you have a little bit more trouble. You have to do a lot more paperwork, you have to send a lot more documents, and it really can become really hairy depending on how many streams of income you have from all your from all your 1099 income or your self-employment income. Also, the lending, when it comes to W income, if you just have 1 year, they generally can just use that for income from the previous year, but when you're a self-employed person, they usually need 2 years. Now, how you can get around this is if your business that you've been in has been around for longer than 5 years, then all of a sudden they can then they can generally just use 1 year if your business has been in business for a long period of time for you to qualify based on your income. And so that's another big factor that banks are looking at is just your employment history and that you've been in the same industry for at least 2 years is generally like a good safe rule. All right, the third factor that the lending institutions look at when they're getting ready to give you a loan is your debt to income ratio. Now, this might sound crazy, this might sound a little weird, but it's actually really, really simple. So let me actually give you an example so you actually can figure out what your debt to income is right now. So let's say that you have student loan debts for $300 a month. And let's say that you have a car payment for $200 a month. Let's say your rent is $1,500 a month or a mortgage, right? So that means altogether, you basically have $2,000 worth of monthly debts every single month. Now, these are only payments that get reported on your credit report. So your rent might be on there, but if you have a different mortgage, it'll be on there. So these are the only things that get reported. So let's just say that altogether, all your debts accumulate about $2,000 every single month. Now, let's say that your income that you make $4,000 every single month. So this would be a 50% debt to income ratio because your income would be $4,000 and your debt would be $2,000. If you divide $4,000 by $2,000, you get 50%. Okay, that would equal 50% debt to income. Now, when it comes to loans, on a conventional mortgage, 50% is basically the most you can have. On an FHA loan, you actually can have 55%. But honestly, the key is not to just get to those numbers that have a little bit of wiggle room. So if you can get your income up to $4,500 or $5,000, all of a sudden you can have more like a 40 to 45% rather than 50%. Or you can just drop your expenses as well. So you can play either way to do it. But you at least got to have 50% debt to income ratio before a bank will even look at you whether they're going to give you a loan or not. All right, and the last thing that banks look at is actually cash, how much you have on hand. So, of course, in order for you to actually close this property, you're going to need down payment money, you're going to need closing cost money, and you know what? Also, the bank is going to want you to have reserves in the bank as well, just in case things go wrong. So, let's say that your down payment is $30,000 for a property. Well, you got to have at least $30,000, and let's say your closing costs are going to be about $10,000. So, you got to have at least $40,000 in the bank account, and then they want reserves in there as well. And so, let's say that your mortgage on this property is going to be about $2,000 every single month. And so generally banks like to have at least 6 months. They like to see at least 6 months of reserves as well. And so for simple math sakes, that'd be $12,000. So $40,000 plus $12,000 means you gotta have about $52,000 on hand in order for you to close on this property. And so that's what you're looking for when it comes to having cash on hand, is again enough for your down payment, for closing costs, and then of course reserves as well. All right, guys, so we just went over the 4 things that you need to look out for when it comes to actually getting a home loan. And I'm telling you what, there's actually a bonus one here that I'm gonna share with you. And so before I share this bonus one with you, like if you like what you're hearing so far, and this has actually been educational, this has been useful, please like this video, subscribe to the channel. I'm gonna be posting more videos just like this all the time. All right, guys, and the 5th and the final bonus one I'm gonna give you is actually just finding a good loan officer, right? Finding somebody who actually can work with you, who can help you and kind of like push things around to make sure that you look really good on paper. Because at the end of the day, like that loan officer, they're on your team. They want the same thing you do. They want to close on this property because you know what? They get commission. They get incentivized for you to actually close this loan. And so they're gonna be working with you. So I'm telling you what, I've worked with loan officers who have had all these things lined up and I couldn't get approved for a loan. And I've worked with loan officers where I didn't have all these things lined up and I was able to get approved for the loan. So I'm telling you what, like the bonus, like a big factor is this actually the right person who can push through and make things work for you to get the loan done. So ultimately that's all that really matters, is that you have the person in there who's got the most weight, that's the loan officer. So hopefully this video has been really informational and really useful. And again, if you liked what you're hearing, like this video, subscribe to the channel, share this with your friends, and let's go buy some houses together. Let's go.